Today is Wednesday, April 7th, 2 p.m. section. What we're going to focus on really for most of the class today is doing the Nike valuation in class using the Walmart model. And this will be the reusable model that you'll use to do your next homework assignment individually, which is due Monday, which will be on the company Starbucks. I was reading this morning that apparently there's an oat milk shortage, which I guess if you're an oat milk person is important in Starbucks. So I thought it'd be interesting to do a valuation of Starbucks just based on what's going on with them. In any event, so that's where we're heading. And then this is also the model that you're going to use in a week and a half for your group project and process on General Dynamics. So let's go ahead and get started, as I said. So what I'm going to do is just kind of take the model that we did in class on Monday at Walmart and build Nike from there.
All right, thank you.
Love you.
All right, Tim. Did he wake up?
All right. So whoever's there, can you put yourself on mute? Great, thanks. This was section 301. Sorry, I've got a lot of files open on my desktop. Okay. Share desktop. All right. So I'm going to start out with our Walmart bull model that we did in class on Monday. And so it really doesn't matter which one you use. You need to just start out with one of your existing Excel models. And then what we're going to do is I'm going to save this as the Nike as is. Because the first model that you're going to do for any company, including Starbucks, would be the as is. So section 301. And I'm going to put this into the Nike folder. I have my desktop here. All right, so right now, this is essentially Walmart's data in a file that's called Nike. So what we're going to need to do, start to put Nike's data in. And where it starts is with this tab, which is the model data tab. So this is 6 years of historical Walmart data. We need to put in, if we're going to do the Nike valuation, we need to overwrite it and put in 6 years of Nike data. So back to our Bloomberg account for Nike. Under FA, what you should have done is at this point, under custom, you should have recreated this, which is our model export template, which again, under settings, make sure that you have 6 periods. None of these are checked. And you're basically exporting this to Excel. Right now, you need to make sure that you're in your Bloomberg with the Excel add-in, because if you, and I have 2 copies of Excel on my computer, if you don't export it to the Excel add-in, it will just error out like this. So for some reason, I can't get it to export to the Bloomberg version. So let me just save this as Nike data. This is section 301. Downloads folder here. All right, so that if you do export it to the right folder there, then when you open the file with the Bloomberg with Excel add-in, and you'll know that you have the Excel add-in because in the Excel menu across the top, it will have Bloomberg listed, then the file will get populated with numbers. So that's just another example of if you leave the cloud with this file, it's going to error out. It's not going to be able to find the data whenever you open this Excel file. So that's going to become a problem. So we have to make sure that we leave the cloud with numbers. So in order to do that, we're going to select the tab, copy the tab. We're going to right click on the tab, paste special values, and that's going to basically overwrite everything on this template with a number. So there's no longer formulas here. These are numbers. So that if I leave, so I'll quit out and reopen in a regular version of Excel. If I leave the cloud and I open the file up in Excel, it doesn't error out, okay? Because these are now numbers, they're not formulas. And so our next step, and by the way, I'm about to skip in a very important step just to show you something, but our next step would be to copy the data into our model. So skipping a step, copy all this Nike data, go to our valuation model, which had the Walmart data, right click on the model data tab, paste special values. That's going to overwrite the Nike data over the Walmart data, right? And then my next step is to check the CFI. And I'm looking to make sure that the CFI balances. Now, the next thing I'm going to notice, I have all these errors in all of my models. And I did this to show you a point that was missed by somebody in the 11 a.m. section. This is why it's important to get rid of these long dashes. So when I told you on Monday that Excel chokes on long dashes, that's what I'm talking about. It will error out all of these formulas in your model. And it's because we didn't get rid of these long dashes. So I left them in just to show you what will happen if you don't do this. So how do I get rid of the long dashes? I'll do this right here in my Nike model. You copy them, Control C, you find, edit, find, or Control F, find the long dash, paste it in, replace it with zeros, replaced all, and then your model's not broken. And more importantly, it balances, right? If it doesn't balance, that means that Bloomberg has added a field to whatever company you're looking at that's not on this list. And down at the bottom, we would have to append it to the bottom of the list and then add it into our model. Okay? That shouldn't happen to you, but on the off chance it does, happens every now and then, that's what would cause the CFI not to balance. So got to make sure your CFI balances, so we're not adding any accounts. They didn't have any at Nike that were non-standard. So essentially, we're now ready to continue on updating our model. So the next thing we're going to do, this random tab is in here, get rid of it, is we're going to go to our assumptions tab and start updating the assumptions. So the first one is make sure we have the right last reported year. So model data, we can check this. Here it's 2020. So Nike actually reports their data in May 31st is their end of their fiscal year. So this is not 2021, it's 2020. So we've got to change the assumptions here to 2020 is their last reported year. Now we're going to leave operating cash as a percentage of revenue the same. And then we're going to need WACC and some other data. So at this point, we're going to go to Bloomberg and we're going to need basically 3 screenshots in an Excel export. And I recommend you doing them about the same time, right? So the first screenshot we'll need is a WACC. We'll go to WACC for Nike, take a screenshot, save it. Second one, I've already done this, go to DES because we're going to use this for not only for the share price for our valuation as is, but we're also going to get the shares outstanding down here. Take a screenshot, save it. Then we're going to go to EEO, and we want to do this at about the same time. And the reason why, screenshot, save, is not only are we going to use this for our revenue and EBITDA, but we're going to use this to get our multiples in our out years. And these multiples are based on the share price. So there's a long lag between the time you do these screenshots, like we did with, for example, Walmart. We did them days apart. A different share price creates different multiples. This makes our model less perfect, for lack of a better word. So doing it around the same time just makes it a little bit more in sync. And then finally, same reason, we then go to RV, custom. We go to, and I'm using analyst curated for my source, but our multiples template, again, settings, global settings, make sure you're exporting static data, which is something you can do with RV. You can't do it with FA anymore. And export that to Excel. Right? So 3 screenshots and Excel export. And again, these multiples are based on current share prices. So we want to do these multiples again around the same time we're doing the screenshots, just because we want all the data to be in sync. Right? So now I'm ready to go back and update my model. Now, just to be consistent with what I had done in the earlier classes today, I took those screenshots and did that data export during the 11 a.m. section of the class today. So that's the data that I'm actually going to use for this model. So over here, first, take the WAC screenshot, open it up. The WAC was 9.7, didn't change. So here, change the WAC to 9.7%. Next, we'll talk about G later. I need my share price and shares outstanding. That was off the DES screen. On the DES screen, this morning, the share price was 137.51. And the shares outstanding were 1275,275 million. And then off of the earnings estimates, these were the revenue and EBITDAs. So 43,301. Let's start putting that in. What else do we got here? 48,600. For 2023, 52,856. And a 57,186. The EBITDAs for the 4 years are 69,43. 84.50, 96.09, and 10.423. And my second forward year, 1-2, EV to sales is 4.48. And I'm going to do the fifth year, which is 4.12. And EV to EBIT was 29.4. And 2501. All right. So very quickly, I've just updated my assumptions with my screenshots. Okay. Questions about anything I've done so far? Pretty straightforward. Next, we're ready to go to our ratios. The 80-20 rule for the valuation are these are the 3 most important ratios: revenue growth rate, EBITDA, and tax rate. So we're going to start there. Start out with the tax rate. I need a realistic tax rate for Nike. Remember, these were Walmart's numbers. All these ratios were Walmart, so I got to change these. So what is Nike's realistic tax rate? Again, I'll go to Bloomberg. When you're on the company, GUID is company guidance, right? So we can see whether or not Nike had given guidance. Last time they gave guidance for tax rate was 2018. So they haven't really given long-term tax rate guidance. So I can't use that. Secondly, I can look at transcripts of events, earnings calls, et cetera, to see if it came up. TA is the transcript analyzer. Now I'm going to search through the transcripts. These are the Nike transcripts for tax rate. I want to do this as an exact match. And so this was the tax rate mentioned in the calls. So in the last earnings call, they talked about tax rate a couple times and said effective tax rate to be the low to mid-teens. Okay. Now, I also think you can go to BRC and look at what the analysts are saying, because these are where the sell side research reports. And I will just tell you, based on my experience, JP Morgan always seems to include a tax rate forecast. So I'll just pick a recent JP Morgan analyst report. Here's one on March 24th. And I'll just do a quick search for tax rate. See what they're using. And they're using 17.3% in the out years. So kind of mid-teens is what the CFO of Nike said. Looks like the CFO probably in the transcript. So back to forecast, I'm going to make this 17.3. Actually can't type 17.3 going into the out years. Okay. So that was the Nike tax rate. Next, I need a Nike EBITDA margin. These are Walmart EBITDA margins and Nike growth rates, right? So as a starting point, they got the perpetuity year. For this operating income, this should be the same as these numbers. Now I have to decide, because for Walmart, they were in sync. For Nike, they're not in sync. This is the perpetuity EBIT margin based on these multiples. And I have to decide which of these two is probably more likely to be used in perpetuity. Well, if I actually look at the ratios for Nike, the out year probably looks closer to, based on this data, 16.5 looks closer to what I'm seeing here for my EBIT margins than the 15s. So I'm going to use the 16.5. Okay. So how do I get to 16.5? Well, basically, I'll make this 18.4. And this will be 18.3. I'll just smooth it out between those 2 years. So essentially, I change the EBITDA to change the EBIT margin or operating margin. Questions about what I just did? Now, the other thing that you should do is you should always do the EIC before you do this. And by doing the EIC, it also would have led me to, which we'll talk more about a little bit in a few minutes, but why I chose the higher rate. Now, last but not least, I need a realistic growth rate in the out years. Again, these were Walmart's growth rates. I'm going to reset these to be Nike's growth rates, so equal the previous year in 2024. So I need growth. I'm trying to match the share price within $1, and I need a realistic G. Okay, so that's what I'm kind of down to. And then finally, I'll mention one other thing that didn't affect Walmart but might matter with Nike is this ratio is called invested capital to sales. Where did this ratio come from? This is the ratio when we did our ROIC trees. How much investment per dollar of sales is being spent. We didn't really talk about it for Walmart because it really didn't change. Like Walmart's productivity stayed pretty constant over time, and we didn't expect it to change in the future. That may not be the case for Nike, because if we look at these numbers, we see that invested capital sales spikes between 19 and 20. It goes from 26 cents to 36 cents because they're spending a lot more on PP&E and more on working capital. You can actually see this right here in the ratios. These balance sheet ratios, which are all our percentage of sales, spike here in inventory and here in net fixed assets, which is causing invested capital sales to jump. Now, if we had done our CFI analysis, we would have also noticed that given depreciation, Nike was spending a lot more on CapEx than depreciation, signaling a big expansion, big growth. So the point of the story is they're changing their productivity. And we have to make a determination about whether or not this is kind of a blip that goes back to normal, or whether it's a level of investment that's higher going forward. So back to ratios. This cell here, which is 824, is the ratio of invested capital to sales on a go-forward basis. And so the question is, are the out years going to look more like 2020, or are they going to look more like 2019? So is it going to go back to where it was in 2019, or is it going to stay where it was in 2020? So I need to kind of understand what's going on with the company to answer that question. Now, what Nike's doing is they're making a big spend on digital. Over half their sales are going to be digital, and they're going to have a lot less physical stores as they sell more stuff online, which suggests that they're probably going to have less PP&E to sales long term. So I don't think they're going to stay at 21%. I think it's probably going to go closer to where it was historically. So I'm going to put that at 16. And I also think inventory is going to go back down as they improve their supply chain. Those are COVID issues that I think they were running into. So this might go back towards where it was historically, closer to 16%. So the point is, these out years look more like where they were historically for productivity. And by the way, the share price is adjusted accordingly. So again, many times when you look at this, you don't have to adjust the balance sheet. We didn't adjust it for Walmart. I'm adjusting it for Nike because it really is changing. When we built this, all these ratios are a percentage of sales. I told you when we put these as a percentage of sales, there would be a second reason why we did everything as a percentage of sales. This is actually the why. By doing all those balance sheet ratios as a percentage of sales, then what we're basically saying is every time we grow sales, the balance sheet grows with it, grows at a constant rate. So what is gross investment and the free cash flow? Gross investment's the change in the balance sheet. So basically by driving sales, we're forecasting a balance sheet, which is creating the free cash flow. So we never really had to worry about the balance sheet for Walmart as long as the productivity doesn't change. But if the productivity does change, then that will affect free cash flow. And that's where we're actually making a change here in the Nike valuation. Questions about why, how, what I'm doing? All right. So therefore, if no questions, then it's just growth. Do I have the right growth and do I have the right G? Now, in order to get the right G, the challenge is, back to this DCF, most of this G is going to be here. It's going to be in the continuing value. This is the formula we were using for continuing value. And slight changes in G, value drivers, are going to have big impacts on continuing value. And we kind of eyeballed and spitballed the Walmart G. And I'm not saying that's the best way to do G, because a couple of tenths of a point of a G can actually have a huge impact on value. So how do we make sure that we actually have a reasonable G? Well, this is where key value drivers will help us out. So in the reading, in the book for this week, which is going to be our next section of the class, we're going to talk about multiples. And in those lecture notes, and in the book, lecture 6, this is going to be one of the things you're going to read about in the book, but this is the formula for enterprise value to EBIT multiple right here. Okay. And what it really represents is this is the key value driver formula, just rearrange math. Key value driver formula, rearrange, gets you the enterprise value to EBIT multiple. It's actually where you're going to realize that all multiples are just rearranged key value drivers. So it goes back to the idea in finance that there's a law of one price, which means just because we change the methodology for valuing a firm doesn't mean it changes the value of the firm. The value of the firm is the value of the firm. So if we change our formulas, we should still get the same result. And so academically, when we change the formulas, what we're really doing is we're just rearranging the equations. All right, so multiples are just a rearranged DCF. DCF is based on KVD. EV to EBIT is based on KVD. This is the rearranged KVD. So I'm going to take a quick screenshot to remind us of this formula. Put in our model here. And here's the point. I'll actually put it over here in the assumptions tab. But this is the formula for enterprise value to EBIT. which is basically this. It's based on this formula. Now, what we're trying to do is we're trying to figure out a realistic G. So here's the idea. I know what the EV to EBIT is. It's right here. It's observed in the real world. I have a pretty good idea what the tax rate is. It's not going to change. I have a pretty good idea what the ROIC is. And we know if a company has a high ROIC, slight changes in the ROIC don't affect the key value drivers all that much. And I kind of know what the WACC is. Unless I think Bloomberg really screwed up the WACC formula, that's the WACC we're going to use. So if I know all those variables, I can solve for G. So that's the point. We're going to use the multiples to not only help us estimate the EBIT margin, we're going to use the multiples to help us estimate the G, right? Based on what a company's trading at, rather than just making up a G. So basically, what I'm going to do is the model is going to calculate an EV to EBIT multiple over here in cell D20. Right? And it's going to calculate it based on this equation over here. So I want to put this equation right here into the cell D20. So you're going to need to do this as well. So what is the equation? Equals left paren 1 minus the tax rate. Well, what is the 1 minus the tax rate? Tax rates on the ratios tab. Column M10 is the perpetuity tax rate. Right paren times left paren 1 minus, I can see right here, next on the assumptions is the G over the ROIC. Well, the G is B7 divided by the ROIC, which is B6, right parentheses, and then take all of that, left parentheses, right parentheses, and divide that by left parentheses, the WACC, which is B4, minus the G, which is B7, right parentheses. And that would get me an EV to EBIT of 10.55, 10.56, assuming a 2.2% G. What I'm trying to do is to say, look, if this is the trading multiple today, 2023 of 25, how do I get a G using this equation to get this to match? So obviously my G is higher than 2.2. What if my G were 5%? Well, that would be an EV to EBIT of 16. What if my G were 7%? Well, that'd be a little higher. What if I did this in the last class, what if it were 6.83%? And then I'm pretty much matching the EV to EBIT in the real world with the one here in the model. So this is probably a much more realistic G in terms of what the analysts are using to get the current TCF. Again, I'm going to pause for any potential questions.
Yeah, Professor, I have a quick question. I'm just confused why there would be a, well, what's the connection between the EV to EBIT and what we just calculated?
So this EV to EBIT is basically the EV to EBIT, which is based on $137.56 share price we're observing in the real world. This leads to an enterprise value divided by second forward year EBIT, or third, we're actually using second and third year EBIT. So you divide that by the EBIT and you get the EV to EBIT multiple. Okay, so this was the two EV to EBIT multiples we're observing. This is the enterprise value to 2023 EBIT and enterprise value to 2024 EBIT. Now, a few minutes ago, I was telling you that I'm using the 2023 EBIT here, this one, in perpetuity. I thought that looked more realistic. So 2501 is the number that based on the current share price of Nike. So here's the point. What G in our model gets us to a 2501 EBIT? I'm solving for that. It's about 6.83%. Okay, because like I said, I know the tax rate. I know this number needs to be 2501. I know the WACC is 9.7, and I know the ROIC is somewhere in the high 50s or low 50s, 51.9. So I'm just solving for G, backing into a G to make this work. So that has to be the G. based on the current share price, because this is an as-is valuation. And by the way, with that G, my model calculates a share price of $150.62. I need to get within $1 of this. So what if this were 3%? Now I'm within $1 of the share price, and I've completed my Nike as is. Questions? For this as is, if you're following along, you don't have to be exactly whatever I'm at, 47 cents of the price. You could be within $1 because you're not actually turning this file in, but you'll need to do everything I've done here to do Starbucks on Monday. Again, questions? Now that we finish this, we're ready to do our bull, our bear, and create a target to create the buy, sell, hold opinion. As I mentioned before you do the bull and the bear, you need to do your EIC. And eventually we also need to sync it against a sanity check, which means I have to have the multiples in the model to compare against the multiples in the real world. Now, these are Walmart's multiples. They're not Nike's multiples. So I'm going to delete the Walmart multiple data. And I'm going to go to that fourth file that I downloaded, which is the Nike multiples file, which I've done the 11 a.m. class as well. And this was the multiples exported to Excel, edit, paste special values. So this was the multiples as of the 11 a.m. class, which is as of the 137 share price for Nike and all of its peers at the time. Now, there was a quirk between our model multiples and the Nike multiples, which I'm still trying to figure out how the Bloomberg value was a little bit off from what we have. And Bloomberg is making some kind of adjustment with Nike, and I'm not exactly sure what they're doing. But for purposes of what we're trying to do, I'm not going to say it matters as much because I need the range of multiples in the industry to basically do my sanity check. Ideally, I want these to be exact, but for our purpose today, we're going to assume that they're not exact, and that's okay. All right, so now I'm ready to do my sanity check. So back to the bull and the bear. Let's say we're doing our EIC, and we don't have time to do a full EIC, but I'm at least going to go back to Nike. I'm going to look at the BICO, because part of my EIC is not just randomly throwing numbers in and seeing what happens. It's about understanding what are the potential real world assumptions that need to be made and how would they play out in the model. So let's see what's going on with Nike. So just kind of reading some of the BICO data here, right? So Nike's disrupted by COVID. They're targeting online. Over half their business should be online by 2023, up from 30%. Imports are important to them because China produces 22% of their shoes, Indonesia 24%, the other half are made in Vietnam. Okay, China and women's are also very important to their future sales, and they're trying to drive shorter lead times and reduce working capital and inventory. Right? So back to what is Nike also trying to do? They're trying to grow by going after the under $100 shoe market, which they're considering to be discounted shoes, which is considering a big change. Still think that's still an expensive shoe, but regardless, they see some opportunity for growth in the sub $100 shoe market. They also see their regular shoes doing well, but most importantly, they think that as a sports-driven company, the Olympics coming up should be a catalyst for their sales. They tend to do better in the Olympics. And they also see digital becoming very important to them. They try and drive digital sales, which also will reduce some of their footprint. And athletics are also important. And the other reason why athletics are important is because They're going to put gaming elements in their shoes, including some cool ways to scan your feet to get better fitting shoes. And the women's market is also a big source of growth that they are targeting. I don't know if you're aware of this, but the women's apparel market is about twice the size of the men's apparel market for traditional apparel. So when they think about sports apparel and athleisure, Nike thinks that women's market has bigger growth opportunities, and they're going to spend more focus on women's clothing, women's shoes. Right. And they also, female tennis, one way to get there. Still do lots of endorsements with athletes, important to their brand, and speed to manufacturing, speed in their supply chain, speed to bring products to market faster, design them faster, and to go into what they're calling the express lane for their supply chain. So they're also using RFID to try and drive down inventory. So I go back to when we start to look at what Nike is doing, these are some things that are important to think about as we go into the bull, the bear, and the target valuation. That's why I go back to it's very important to do an EIC before you do the bull, the bear, and the target. So with that in mind, let's now do our bull, our bear, and our target. So I start with my as is, I save my as is, and then I file save as, and I'm going to call this my bull. So now I'm ready to do my bull. So this is my optimistic scenario for the next 12 months. Now in your papers, so you might say, well, gee, Professor Buffet is expecting me to write a 500 word paper. What goes in it? Well, in the paper, what you're writing is, what are the key assumptions? Growth rate, EBITDA margin, tax rate, G, any balance sheet, productivity issues, WAC if it's an issue as well. And how does it change in each of the models and why are you changing it? And so you're going to write it out for Starbucks. You're going to talk about it for General Dynamics when you do the PowerPoint. But that's the idea. So what's driving the bull, right? So a couple things. Start here with the ratios. Number one, I think that Nike is going to get higher growth rate in the out years. Why? Because they're going to be successful in the under $100 market. That's going to expand their sales base. They're also going to be successful at driving future women's clothes. So instead of growing at 3% a year, this is going to maintain high growth rates closer to 7% a year. I also think that given their focus on digital, that actually in digital innovation, that actually could get their margins up even higher. And so instead of 18.4, I'm going to say 18.6 in the out years for EBITDA margin. I'm also going to make an assumption that the tax rate's not going to go any higher because the Democrats are going to be unsuccessful against the Republicans at getting a global tax or higher tax rates. So tax rates for corporations stay about the same in my bull scenario. Back on the assumptions, I also think that the G is going to be higher. I think it could be as high as 7.5% for the same reasons, because they're very successful in the athleisure market, the growth in women's, and that extra growth in China and other markets allows them to continue growing and rapidly expanding. So I think the G is going to be even higher in the out years. So I'll say 7.5%. By the way, what does that translate to? That's $188 share price. So with that, sanity check. All right. These multiples are starting to get pretty high. All right. On an EV to sales, now Lululemon is a little bit higher at this end of the industry, but they're topping out against everybody else, including Lululemon on every other ratio. So 188 is probably getting near or even above the high end of the bull range. So I might temper that down a little bit and I might call this 7.3. So 7.5. Which gets me to a share price of 174, which gets my multiples a little bit lower. Now a little bit below Lululemon. And I think that's probably closer to what I'll call my bull range. Then I'll go back, and it's usually easier to do this with your as is. Go back to my as is, file, save as. Now I'm going to talk about the assumptions for my bear. What are my bear assumptions for Nike? Well, my bear assumptions are that that $100 shoe focus turns into a debacle. And what ends up happening is Nike ends up diluting the brands because people start to realize their shoes are overpriced, and it actually gets more volume, but lower price shoes, and it starts hurting their sales with their higher end shoes. So instead of growing at 3% in the out years, they're only going to grow at 1%. And it's not that they're not growing, it's just they're going to grow it and price pressure is going to actually hit them. They're going to grow at lower prices to get the volume. I also think it's going to put pressure on their margin. It's going to look more like their historical margins. So it's going to shrink back down to 16% because I think the market is going to get much more competitive. And I also think that they're going to sell more of their discount shoes, and it's going to hurt their premium brand. So the mix is going to shift, which is going to lower their overall G to 5%. And I also think that the taxes are going to go up to 21%. And there's going to be a minimum global tax starting in 2022 that all corporations are going to pay, which could drive their share price to 73. Now, again, when I go into my multiples, this is actually looking even worse than Under Armour for most of these ratios. So I'm actually probably getting a little bearish on Nike, but I might have overdone it. So, but directionally, I might be right. So I'm going to pull back on the growth, and maybe this is going to be more like 6.5%. And that's $98 a share. And I say that these multiples are now right where Puma is and right where Adidas are for a couple of these ratios. So, all right, I could say that this is probably near the bottom of the range for Nike. So back to my bear. My bear is $198 a share. My bull is about 170-ish. And so where do I think they're going to be on the range? So I go back to my as is, file, save as, target. And then I put in my target share price for Nike. And the target is my opinion. Okay. And my opinion could be anywhere in that range. Right? And as long as it's within that range, I don't have to do a fourth sanity check because by definition, if I've done a sanity check for my bull and my bear, my target within the two should be a reasonable number. So the question is, where in that range do I think Nike is going to end up? Now, personally, I actually think Nike is going to do a little bit better. Right? I actually think that they're going to get closer to the bull range than the bear range, given everything we just read about them. Meaning, I actually think that they are going to be successful in the and markets without cannibalization. And I do see the opportunities that they talk about in both women's sports as well as China as growth vectors for them, so they can maintain higher growth rates for longer periods of time. So I'm going to put these growth rates at 5% in the out years. I am going to say that we are probably going to be faced with some level of higher tax rate, but I do think that the G's are going to be higher, and this G might not be 7.5%, but it might be 7.2%, which gets me to an overall share price of 152. Now Nike's at 137 today. $14 on top of 137 is 151. So I'm right at the edge of the buy. So I would argue that Nike is a buy with a share price target of 152. That would be my assignment. That's what I would turn in. Questions? You want to see how they're doing in the real world? Here's what the analysts are actually saying for their targets. Average analyst puts them at 163. You got some analysts in the 180s. There's a 180, there's a 185. You got some analysts that are lower. There's a 136. And that's the point. When you get to the target, there's disagreement because we'll predict the future. And some people could have more pessimistic assumptions. Jefferies with a price target of 140. Some people could have more optimistic assumptions. Morgan Stanley price target of 173. Because again, they're going to have slightly different assumptions in their model. And it's whether or not you believe those assumptions, which is going to matter more. But nonetheless, that's what you have to articulate when you turn it in. So it's not a right or wrong answer for the target, as long as you're explaining the key numbers that you are driving. So what do you need to do for your model? Because you don't have to turn in anything we've done into class today, but to make sure that you're ready to do future assignments. Number one, you need to make sure that you know how to update the data. Number two, you need to know how to estimate a G more accurately for the firm. So there's the formula to help you do so. Number three, you gotta make sure that you have the ability to adjust the balance sheet if necessary. Now, again, for most companies, you don't have to adjust the balance sheet, but in the case of Nike, we thought it was warranted. And you have to update the multiples file as well to make sure your sanity check works with a more realistic set of assumptions. You'll create 4 versions of your Excel files, your as is, your bull, your bear, your target. Your write-up will also include the 3 screenshots, the DES, the WAC, and the EEO. 2 reasons. 1, it's to make sure that you're doing this assignment individually. And 2, it's also to ensure we understand the basis by which you did the valuation. And what I mean by that is that you're doing a valuation at a time and the prices are going to change throughout the week dynamically. So you might actually get different numbers and different assignments based on when you did your assignment. So the screenshots help us understand how you synced up your numbers. The TAs will have copies of this file. So if you have any questions, they have office hours the next 2 days. Your assignment on Starbucks is due Monday, 10 a.m. for all sections. We'll talk about it in class on Monday. So before I turn you loose to work on Starbucks, again, questions?
You can go, sir.
Oh, okay, sorry. Would we be able to see where the trading challenge is going?
Sure. I'll put it up right now. All right. Who else had the question?
Hi, I'm not sure if you know how or why this could have happened, but while I was doing like the work we were doing in class, for some of the tabs, like for example, my income and balance sheet, everything got like the equations were off by the model data. Like they were pulling from C when they should have been pulling from B, but it was only like on random sheets that it did that. I'm not sure why.
So it's pulling from the wrong years. You got like the wrong.
Yeah,
years.
but it's only on certain ones. Like the income and balance pulled from the wrong years, but like the TFI and the TII is all pulled from the correct years.
Well, the TII and the TFI are probably pulling for the correct years because they're tied to the income and balance tab. So they're always in sync. So this is set up to pull from this, and you're not changing the structure of this tabs. The TII and the TFI should work. It just means that there's probably either something here where you just copied and pasted the wrong column. So for example, in an earlier class, somebody just pasted it in wrong. So that's a possibility. The other thing is you pasted it in right, but you forgot to change your last reported year.
I changed the last reported year. I'll look and see if I pasted it wrong.
But you could have copied and pasted it in wrong because it's really easy to do. But stick around after we let everybody else go. If you want to share your screen, we can poke around and look.
Okay.
Other questions? All right, well then I will let everybody else go and you're welcome to start on the Starbucks assignment. And otherwise, we'll see everybody else on Monday. Have a good week.
All right, thank you.
And then I'm stopping the recording.